Welcome back, everyone. It's that time again, 45 days after the close of Q4 2025, which means the 13F filings are officially public. For those unfamiliar, this is essentially our window into what the world's sharpest investors have been buying and selling over the past quarter. And I'll be honest, I thought this cycle might be a quiet one, given how hot the markets have been. But once again, I was completely wrong. There's plenty to unpack, so let's get straight into it. Story number 1. Super investors loading up on Amazon. The first major headline from this round of filings is that some seriously respected names are making big bets on Amazon. Seth Klarman opened a brand new position, putting approximately $500 million to work, picking up around 2.1 million shares. That stake jumped straight to the second largest holding in the Baupost portfolio, representing over 9% of the fund. That's not a toe-in-the-water move, that's a conviction buy. Meanwhile, Bill Ackman over at Pershing Square added 65% to his existing Amazon position, building on what he first established back in Q2 of last year. Amazon now sits at nearly 14.3% of the Pershing Square portfolio, the third largest position behind Brookfield and Uber. So why are two of the most respected capital allocators in the world piling into Amazon right now? To understand that, you need to think about Amazon as two distinct economic engines. First, you've got the retail side, Amazon.com, Prime, advertising, international. In 2025, that generated over $588 billion in combined revenue. Huge numbers. But here's what might surprise you. The operating profit from all of that was only around $34 billion combined. Then you've got AWS. AWS brought in just $128.7 billion in revenue, a fraction of retail, but kept $45.6 billion in operating profit. That means AWS, despite being only 18% of Amazon's revenue, is responsible for 57% of the company's total operating profit. It is, by a wide margin, the more valuable engine. And right now, AWS is in full growth mode. Amazon has announced $200 billion in capital expenditures for 2026 to expand their AI infrastructure. Ackman's team at Pershing Square pointed out that AWS's 20% growth in 2025 was actually being constrained by capacity limitations, not by lack of demand. Their view is that doubling data center capacity through 2027 will be rapidly absorbed by the explosion in AI inference workloads. The client list AWS has been adding is remarkable. OpenAI, Visa, Salesforce, the U.S. Air Force, Adobe, HSBC, CrowdStrike, and many more all signed on just since Q3 earnings. The demand story appears very real. Now, to be balanced, Berkshire Hathaway actually trimmed their Amazon position this quarter, so it's not a universal view. But when two investors of this caliber are moving this decisively, it's at minimum worth putting Amazon on your research list. Story number 2. Warren Buffett's final 13F. This brings us to Berkshire Hathaway, and a moment that's actually quite historic. This quarter's filing was the last 13F submitted under Warren Buffett's leadership as CEO. He stepped down at year-end, and while he may remain peripherally involved, the portfolio will now be managed by Greg Abel and Ted Weschler, with Todd Combs having departed to J.P. Morgan. So, what did Warren Buffett do in his final quarter at the helm? Honestly, it was fairly understated, which perhaps says everything about the man's consistency. Berkshire reduced their Apple stake by another 4%, which is notable because Apple is now approaching the same portfolio weighting as American Express, the number 2 position. Just a couple of years ago, Apple made up nearly half the entire Berkshire portfolio. It's a remarkable shift. Beyond Apple, Buffett trimmed Bank of America by 9%, added 6.6% to Chevron, and increased his Chubb position by 9.3%. There was also a new $350 million position opened in the New York Times, though given the size, that's most likely a Ted Weschler pick rather than Buffett himself. And that's it. Quietly, methodically, Warren Buffett's run at the helm of Berkshire Hathaway is over. The numbers speak for themselves. An average annual return of 19.9% since 1965, compared to 10.4% annually for the S&P 500. A $1 invested in Berkshire in 1965 has grown to over $55,000. The same dollar in the S&P 500? $391. There are no words. An absolute legend of investing. Take a bow, Warren. Story number 3, Bill Ackman buys Meta. Now back to Ackman, because Pershing Square didn't stop at Amazon. They also initiated a brand new $1.76 billion position in Meta Platforms, which now sits at slot 5 in the portfolio, representing around 11.4% of the fund. This one is interesting because Meta's stock did pull back significantly in Q4, down as much as 25% from its August highs. So Ackman was buying into weakness, which tells you something about his conviction. His thesis rests on 3 pillars: the moat, the AI opportunity, and the valuation. On the moat, Meta owns Facebook, Instagram, WhatsApp, and Messenger. These are deeply embedded platforms with genuine network effects. Billions of people use them daily. This isn't a company whose survival depends on AI playing out a certain way. The business works today, with or without AI. On AI, Ackman's team views Meta as one of the clearest beneficiaries of AI integration. Better content recommendations mean more time on platform. Better ad targeting means higher revenue per user. Meta is planning between $115 and $135 billion in capital expenditure for 2026, potentially an 87% jump from 2025. Pershing Square's view is that the market is underestimating the long-term upside that AI can deliver for this business. And on valuation, despite the stock rising over 600% from its late 2022 lows, Meta is currently trading at a price-to-earnings ratio of around 22. For a company of this quality and growth profile, Ackman argues that's a discounted price, not an expensive one. His exact words were that Meta represents a deeply discounted valuation for one of the world's greatest businesses. Bold statement, but hard to completely dismiss. Story number 4. Michael Burry closes Scion Asset Management. Moving on, and this one was telegraphed last quarter, but it's now official, Michael Burry has closed Scion Asset Management. There will be no more 13F filings from the man made famous by The Big Short. That said, if you follow his thinking, it actually hasn't gone quiet. Burry has been quite active on both Twitter and Substack since the closure, so those are your 2 best windows into what he's thinking. It's a loss for the 13F world, but he's still out there sharing his views publicly. And finally, I want to close with a story that's genuinely difficult to share, but one that I think deserves to be told with the care and respect it warrants. Guy Spier, a brilliant investor, a wonderful author, and someone who has been a friend to this channel, has made the decision to return outside capital and wind down Aquamarine Fund. But this decision has nothing to do with performance or market timing. In his own words from his most recent annual letter, this decision is not about performance or about the markets or timing. It's about my health and my obligation to treat your capital with the seriousness it deserves. Guy has been battling a grade 4 glioblastoma, an aggressive form of brain tumor, and has had to undergo multiple surgeries. Under those circumstances, stepping back from managing outside capital is not only understandable, it's the honorable thing to do. Having met Guy and the Aquamarine team personally, I can tell you they are among the most genuine, warm, and wonderful people in this industry. This is a tough one to process. And on that note, I want to invite our community to do something meaningful. If you'd like to send Guy a message, words of encouragement, gratitude, prayers, whatever feels right to you, please email Guy Spier in the subject line. I'll personally collect every message, and we'll put together something thoughtful to send to him from all of us as a community. Photos are welcome too. No obligation at all, but if you feel moved to reach out, I know it would mean a great deal. Guy, to everyone watching, thank you for sticking with me through what turned out to be a pretty eventful set of filings. There's a lot to think about across all 5 of these stories. As always, do your own research, think independently, and I'll see you all in the next one.